Okay.
There was not much about doubt about them.
Okay. Just a second. So today we'll be starting with business valuation methods, where I'll be discussing. Hello, I'm audible. Harshita, am I audible?
Yes,
Yes,
yes, ma'am.
Samrit,
Yes.
you are.
Okay, thank you. So I was saying that we'll be starting with valuation methods, where we'll be discussing what are the various alternative approaches that are adopted for valuing a startup. But before that, I'll be discussing traditional approaches to valuation. So let me just share my screen. Harshita, is the document visible?
Yes, ma'am, it is.
Thank you. Okay. So, Naman, since you are the only one here, so I will ask you the questions. Okay. So, I hope so you'll participate. Naman? Okay, so Mohit has also joined. Okay, so what do you understand by the term valuation? It is an estimated worth of an asset or a security or a business. So you are simply trying to assign a price to that business or to that asset, whatever you are valuing. There are several alternative approaches to value a firm or an asset. The first one being the book value of the asset. So as the name suggests, book value simply refers to the amount at which an asset is recorded in the books of account. So suppose you have been given the balance sheet of XYZ Corporation and it shows that the total assets are worth rupees 500 crore. So book value of total assets is 500 CR. Now from this amount, you will deduct the amount of total external obligations. So all your current liabilities, all your bank borrowings, even the preference share capital will be reduced from this book value of total assets to ultimately arrive at the total amount of assets that are available actually to the equity shareholders. So suppose your external obligations come out to be rupees 200 CR. So at the end of the day, the net assets that are available to the equity shareholder will be 500 minus 200 CR. So that is 300 CR is the book value that is available to the equity shareholders. But suppose, let's say that you just have, started running your own venture, you are still developing your minimum viable product, you're working from a makeshift office. So obviously you won't have that much amount of assets with yourself. So obviously in that case, your book value of total assets would be lower. But suppose you're working on a technology and once it materializes, your revenue projections will skyrocket. But this book value of total assets won't be able to capture your future revenues. So that is why book value method is not suitable for early stage startups. But once you enter into your rapid growth stage, you can use this methodology. Next is market value, where you simply utilize the market price of equity share. But we all know that startups are not normally listed, so this won't be available to you, and hence it is not a suitable method. Now we come to intrinsic value. Intrinsic value is simply the present value of all the cash flows that are generated by the business during its course of life, discounted at an appropriate discount rate. This discount rate is the overall weighted average cost of capital, which we discussed in the previous class. But can anyone tell me that why do we use the present value of cash flows rather than just taking rather than simply taking the future amount of cash inflows? Why do we need to discount them?
Samrit,
Yes.
this document is
Yeah,
not visible anymore.
I have shifted to
Okay.
the
Okay,
Teams
okay.
mode because I
Okay.
wanted to see the students.
Fine. No issues.
Naman, Mohit, why do we need to discount our future cash inflows? Does anyone know? यार आंसर करो, मतलब yes बोल दो, no बोल दो. anything or try to guess it?
No, ma'am, we don't know.
Okay. Naman, do you want to try?
No, ma'am.
Okay. So we discount our future cash inflows, or why do we need to take their present values? Because of the concept of time value of money, which simply states that a rupee received today is worth more than a rupee received at some future date. And the basic reason for this is because you have some investment opportunities available to you at present. So suppose you have two options, that whether you will receive 1 lakh rupees today, or 1 lakh uh, 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 receive the payment of rupees 1 lakh after 1 year. Okay, so if you like go with the option one of receiving 1 lakh today, then you can simply invest it. Suppose you invested in a mutual fund at 10% per annum. So 1 year later, you will receive about 1 lakh 10,000 rupees. But in the second case, after 1 year, you will only be receiving rupees 1 lakh. So that is why we need to discount our future cash inflows, and that is why we take the present value of future cash inflows rather than taking the amount of future cash inflows as it is. I hope it is clear.
Yes,
Okay.
ma'am.
Clear.
Okay. Harshita, I'm back to the document, so it's visible, right?
Yes, deal is.
So lastly, the fair value. The fair value simply takes an average of the book value, or the market value, as well as the intrinsic value. Now I'll move forward. These are the numericals that discusses the book value approach. You simply have to go through this document. It is only for your additional reference, for your extra reading. It won't be tested in the majors because it discusses the traditional approaches to valuation. Then we come to earnings-based method. So your intrinsic valuation is simply the earnings-based method. And earnings-based method is based on both on accounting profit as well as cash flow basis. But most of the valuation approaches simply prefer cash flow over accounting profit. And there is a reason behind it. So I am assuming that you won't answer it, so I'll simply answer it for you, that why do we prefer accounting profit over cash flow basis? This is because the estimation of accounting profit is subjective. If you remember that there are alternative accounting practices that are available, जैसे depreciation का एक written down value method होता है और एक straight line method होता है. So suppose आपके पास दो organizations हैं A and B, and both of them are earning the same level of revenue and both of them are incurring same level of cash operating expenses. But one of them is estimating depreciation by written down value method and another is estimating by straight line method. So any valuation difference that will come will basically be on account of differences in depreciation amount and not on the account of differences in their revenue generating capacity. So obviously मतलब इतना subjectivity होता है, so we don't prefer accounting profit. और जो कैश फ्लो बेसिस होता है, इट इज मच मोर कंसिस्टेंट विद टाइम वैल्यू ऑफ मनी. तो सपोज लाइक you had 1 lakh rupee of sales in 1 year, out of which 70,000 were on cash basis and 30,000 were on credit basis. So accounting profit, because it follows accrual principle concept, it will simply record in year 0 that 1 lakh is your total earnings or total revenue, right? But अगर आप cash flow basis follow कर रहे हो, it will say that only 70,000 has been received today at year 0. It is the only amount of cash that is available for me to reinvest, and 30,000 will be available 1 year later, so I need to discount it. Okay, सबको समझ आ रहा है? नमन, मोहित, you can
Yes, ma'am.
stop me, you can unmute yourself, you can ask me doubts if you want.
No, ma'am, it's clear.
I can repeat. Okay. ठीक है. सो यहाँ पर बस सिंपली अर्निंग बेस्ड मेथड डिस्कस किया है, ये उसके न्यूमेरिकल्स हैं. So the DCF approach, which uses the cash flow, According to the DCF approach, the value of business or firm is equal to the present value of expected future operating cash flows to the firm discounted at a rate that reflects the riskiness of the cash flows. So as I mentioned, we will discount it at weighted average cost of capital. There is another variant to cash flow approach where we estimate or where we discount free cash flows. So what are your free cash flows? You simply subtract from operating cash flows all your capital expenditure as well as investment in working capital to ultimately determine that what is your cash flows that are available to your suppliers of financial capital. Because ultimately ये जो amount है capital expenditure या फिर investment in working capital वो ultimately तो blocked है, वो नहीं मिल सकता equity shareholders को, वो नहीं मिल सकता, that cannot be utilized to give dividends to preference shareholders. So that is why we prefer free cash flow. Okay. So that's it. Hum discounted cash flow technique. I will discuss it much more in detail in the upcoming PPT. So all these are numericals and you can refer to this document for reading what are the traditional approaches. So that's it from this document. Any doubts? Mohit, Naman? Okay, I will move forward then. Yes, Mohit, do you have any doubt?
No, ma'am, I don't have any.
Okay. Harshita, is it visible?
Yes, Dee, it's visible.
Okay. So now we move on to the valuation methods for startup. So first they are simply discussing the features of valuation. Valuation is the cornerstone of the investment process. Of course, if I have to invest in a startup, at least I should know that what is its worth, how much will it grow in its valuation. Only then I will be able to invest. Only then I'll invest if it gives me appropriate return. But analyzing investments is challenging, especially for startups. So valuation process is particularly challenging for startups. This is because they do not have much substantial historical track record. Moreover, their information, financial information is not available in public domain. And there is a lot of uncertainty whether the startup will survive in the future or not. Also, if we talk about valuation as a process, you have to make a lot of assumptions about the future. You have to forecast revenues, you have to forecast its weighted average cost of capital, you have to forecast growth rate. So it is the valuation process is complex. Then it says that cash flows are king. So I discussed the two reasons that why we consider cash flows. मतलब इतना emphasis क्यों दिया जाता है cash flows पे, because ultimately that is available to you for reinvestment. It is much more consistent and objective measure in comparison to accounting profits. And it follows the concept of time value of money. Now I will discuss the discounted cash flow method. How does DCF work? For simplicity's sake, we will demonstrate a DCF for an individual asset, the tech widget factory. TWF manufactures and sell tech widgets. So here we'll be discussing the intrinsic valuation method, that is discounted cash flow method. And what they are trying to do here, they are trying to value an individual asset, that is tech widget factory. So the first step involved is estimate cash flows that TWF will generate over an explicit forecast period. Second, estimate the terminal value for TWF beyond the explicit forecast period. So as we know that we assume that a business is a going concern. That is how we do our accounting practices. That is how we value them. That business will go on forever, right? So startup is going to be here for long. Your startup is going to be here for long, and that is how you will value them. But if startup is expected to operate for so long, it is really difficult for me to forecast its cash flows. I cannot like anticipate what will be its cash flow in its 50th year. It is humanly impossible for me, and I cannot do it with like great precision. Matlab, ultimately, it will be a useless estimate because a lot of changes can take place over the 50-year course period. So what we do, we divide the life of a startup into two periods. One is the explicit forecast period where we can, with certain degree of precision, we can forecast its cash flows. And then it's a period beyond explicit forecast period where we try to estimate a terminal value. Terminal value hota kya hai? It is simply the summation of present value of cash inflows that are generated by the startup beyond the explicit forecast period. Then derive an appropriate discount rate for TWF, which is the weighted average cost of capital. Fourth is apply discount rate from step 3 to TWF's cash projection in step 1 and 2 to determine current value. So they are discussing the step 1 in detail, estimate cash flows that TWF will generate over an explicit forecast period. What are the factors that we should think about when developing cash flow forecast? At a basic level, we need to consider all of the cash inflows and outflows that we expect TWF to realize. Inflows include items like revenue, while cash outlays might include operating expenses and capital expenditures required to achieve that revenue. If you think this sounds a lot like company's income statement, you would be correct. But there are a few adjustments we need to keep in mind if we are looking at TWS historical income statement as a basis for DCF projections. So in DCF approach, you will consider all the cash inflows, which are your revenues, and all the cash outlays, which will be your capital expenditure as well as cash operating expenses. But agar if you are using the net income, then you need to make certain adjustment. One is for interest expense. So interest arises out of the financing activities of a business and not out of its operating activities. हम वो cash inflows या फिर cash outflows consider करेंगे which directly arises out of its operations. अगर startup का business है e-commerce, okay, it simply sells merchandise. तो उसका मेन एक्टिविटी लोन प्रोवाइड करना तो नहीं है या फिर लोन लेना तो नहीं है. सो वी वोंट कंसिडर द इंटरेस्ट एक्सपेंस एंड हेंस वी विल ऐड बैक द इंटरेस्ट एक्सपेंस if you are using if you are taking the net income from the company's income statement. Plus the interest expense is already taken into account your weighted average cost of capital, which is used to discount your future cash inflows. Then we will also add back depreciation. Depreciation is added back because it is a non-cash expense. And it also says the reason we make this adjustment is that the economic impact of depreciation should be captured in our capital expenditure estimates. Okay, so let's see that how they are forecasting their revenues and expenses. So in the first year, they are making a revenue of $100 and they are assuming, they are assuming that TWF sales grow at 5%. So in the second year, the sales will be 105. In the third year, the sales will be $110. It will be in millions. Costs are stable at 40% of revenues. So expenses are 40% of $100 in year one. It will give you $40 million. Then in the second year, 40% of 105, it will give you $42 million. And similarly for third year, what will you take? 40% of $110, that will give you $44 million. Then you will deduct the income taxes at the rate of 10% and you will arrive at net income after taxes. In this, from this net figure, so you will add back interest expenses to this net income figure because as we discussed, that it's more like a financial expense and not arising out of its operations. So we will add back. So it says TWF has 100 million of debt outstanding at a 5% rate. So you will add back $5 million every year. You'll also add back the depreciation, which is taken as $10 million, and you will deduct all your planned capital expenditures. That will give you total cash flow from year 1 to 5. So they are forecasting revenues till 5 years because they are taking it explicit forecast period. Any doubts? Did you understand the first step? ये forecasting आप अपने group project के लिए भी कर रहे हो. So I hope it is clear. Naman, Mohit, should I move forward then? Okay, I'll move forward. Then the second step is estimate the terminal value for TWF beyond the explicit forecast period. A terminal value quantifies cash flows that our factory will generate beyond the explicit forecast period. The length of this period can vary. Some assets have very defined useful lives. For example, a computer may last 7 years at most. In those cases, the terminal value may be an estimate of the sale price or any other recovery value we could expect after the explicit forecast period ends. So it can be $0 only if it turns into scrap. Other assets can remain operational indefinitely with sufficient investment in repairs and upgrades. For the remainder of this discussion, we assume that TWF is an indefinite life asset. So it is simply stating that terminal value, as I explained, will be a summation of present value of cash inflows that occur beyond the explicit period. और ये explicit the period beyond the explicit forecast period can vary depending upon the type of asset. So some assets come with a defined life. For example, a computer, it can max work up to 7 years. So ultimately you will have to sell it into scrap. So you can hardly recover any value. So that terminal value can be $0 in some cases. But if you are valuing something like a startup, and as we are saying that it will go on indefinitely, so it will have a certain level of value, and we will see that how we estimate this terminal value. Estimate the terminal value for TWF beyond the explicit forecast period. The calculation for terminal value of indefinite life assets is based on the financial theory that dictates the value of a perpetuity. Without getting into too many details, we must assume that our asset reaches a steady state growth for us to use the perpetuity formula. Other variables needed for terminal value include a cash flow estimate in the year immediately following the explicit forecast period and the discount rate, which will be discussed in step 3. तो हम एक assumption लेके चलते हैं that beyond the explicit forecast period, your cash flows will increase at a steady rate, at a stable growth rate. So this is the formula or the terminal value, which mirrors the perpetuity value formula. Cash flow in the year after explicit forecast period ends. So what will be your cash flow in the year 6 divided by discount rate minus steady state growth? Note that to estimate our initial cash flow forecast in the terminal period, we follow a process very similar to our prior slides. For TWF, our explicit forecast period was 5 years. We might assume revenue grows at 2% in year 6 and continues to grow at 2% thereafter. We will assume expenses remain at 40% of revenue, interest expense and tax rates remain constant, and finally that capital expenditure of $5 million a year are required to sustain 2% growth rate. So they are simply stating जो हमारे बाकी सारे assumptions थे regarding revenue, capital expenditure, interest expenses, they continue to hold, and the stable growth rate is assumed to be 2%. So the startup, its revenue will basically grow at 2% rate beyond the explicit forecast period. So in year 5, as you can see, in year 5, our total cash flow was 65. To this, we will apply a growth rate of 2%. That gives us $66 million. Then discount rate, which is assumed, which is the weighted average cost of capital, it works out to be 12%. And from this, you will deduct the steady state growth rate, which is 2%. So that gives us a terminal value of $658 million. Okay, so next, the step is estimating a discount rate. A discount rate adjusts cash flow for two key realities of the value of the future cash flows to an investor. तो एक तो मैं डिस्कस कर चुकी because we need to find out the present value, because there are many reinvestment opportunities available to you to be to follow the time value of money concept. Interest rate and risk. First, let's discuss the interest rate adjustment. You would not invest 1 million into a venture like TWF if you thought it would be worth $1 million at the end of 5 years. Because obviously, if you have 1 million today, you can put it into a mutual fund and you can get a return of 10% per annum. So it is a sheer stupidity if you will get $1 million at the end of 5 years. A better bet would be to put that money into a safe bank account where you could earn a rate of interest. In finance, this is often called time value of money, and we account for this by discounting cash flows by a benchmark interest rate, usually the so-called risk-free rate. The second discount factor, risk, is also straightforward. You aren't guaranteed to realize future cash flow estimates. For a relatively safe investment, you might require only a modestly higher rate of return to induce you to shift money from the safety of a bank account into that investment. For a risky investment where future cash flows are more uncertain, say manufacturing and selling tech widgets, you would probably require a much higher expected rate of return versus your bank account. The risk adjustment to the discount rate accounts for this. So when you have accounted for time value of money, which will be your risk-free rate of return, उसके ऊपर you will add uh, a risk premium, that how much risk you are taking. Accordingly, you will add a risk premium. So if it is a publicly traded company, if it is a well-established company like Reliance or Tata, so your risk premium will be a little lower in comparison to a startup whose survival is uncertain, or whose future cash flows are more uncertain. So there you will have a very higher discount rate. So probably 40% of rate of return you may require in case of startup. So how do you estimate a discount rate? There are various prominent models like that of capital asset pricing model. So they simply say, in practice, there are several ways to estimate a discount rate. Entire books have been written on this subject alone, and a full discussion is outside the scope of introduction. Some of the most prominent methods include CAPM, arbitrage pricing theory, and market-based approaches. So they are assuming that they calculated the discount rate from a market-based approach, and it works out to be 12%. Any doubts till now? Are there any doubts? So I'll move forward. Now that we have all of our DCF components, the last step is to put them all together. We start with our explicit cash forecast and terminal value, our non-discounted cash flows. We determine the value of our non-discounted cash flows today by multiplying each by a discount factor. So what you are simply doing, आपने year 1 to 5 तक you calculated and estimated your cash flows. Year 6 में you have a terminal value. But as we said that because of the time value of money concept and because of the riskiness of the cash flows, because ये certain नहीं है कि मुझे इतना amount मिलेगा ही मिलेगा, I need to discount them. I need to calculate their present values. So I will multiply each of these cash flows and terminal value by a discount factor. The discount factor is essentially the inverse of 1 plus the discount rate, compounded for the number of years that will elapse between now and when the cash flow will be received. For example, the discount factor for year 2's cash flow is 1 upon 1 plus 12% raised to the power 2, or it works out to be 80%. Once we appropriately discount all cash flows, our DCF value is simply the sum of all the discounted cash flows. In this case, it is $561 million. So आप simply क्या कर रहे हो, आपका 12% discount rate था, you calculate their discount factor which is so suppose let me take year 2, तो वो क्या होगा 1 upon 1.12 raised to the power 2. Similarly for year 3 it will be 1 upon 1.12 raised to the power 3. So they arrived at discount factors for each of these years. So जैसे year 1 के लिए it is 89%, for year 2 it is 80%, for year 3 is 71%. Then I'll multiply it by undiscounted cash flows. जो हर साल के cash flows आए थे उससे हम multiply करेंगे. So 52 into 89%, 42 into 84%, 63 into 71%, and so on. So now you will get in the C step, as you can see, you will get the discounted cash flows. Then you have to ultimately take the submission of discounted cash flows, which works out to be $561 million. Okay. Clear है कि discounted cash flow technique क्या है, because this is the most popular technique for valuing any business venture. Did you understand the concept? Naman, Mohit. यार दो ही जवाब हो सकते हैं ना, yes और no. तो yes बोल दो या फिर no बोल दो.
Class, please respond at least. Naman, Mohit, are you guys there?
I don't think so they are there.
They have just joined the class and just left it like this. This is really bad.
Okay, so I'll just move forward then. Harshita visible है ना?
Yes, it's visible.
Then we come to alternative approaches. So as we see that DCF involves a lot of calculation, मतलब बहुत ही complicated procedure है जहाँ पर आपको forecast करने revenues, you need to estimate the weighted average cost of capital, you need to make a lot of assumptions. So ultimately it's a very complicated procedure. So many alternative approaches to valuation have emerged, and we can largely classify them into two categories. One is the intrinsic valuation and the second one is relative valuation method. Intrinsic valuation are bottom-up frameworks that look to gauge asset values solely on the basis of that asset's fundamental properties. तो उसमें आप क्या कर रहे हो कि whatever is the assets that are available to the business venture, you look at them, you look at its fundamental, that what is the cash flow generating capacity of that asset, or what is its book value. So you look at those properties of the asset. The DCF is among the most prominent intrinsic value approaches. Net asset value and book value are other common methods. So I have discussed the book value concept when we were discussing the traditional approaches to valuation when we were discussing the previous document. Relative valuation methods look to estimate an asset value based on the market value of comparable assets. So suppose now that Zomato is now listed and I want to estimate the value of Swiggy. तो मैं क्या करूँगी? I will look at the market value of Swiggy, and based on some common metric, let's say sales, उसके basis पे मैं Swiggy की value compute करूँगी. The most prominent examples of relative valuation are multiple-based analysis. For example, price to earnings, enterprise value to EBITDA, price to sales multiple. The basic intuition of these valuation methods is same. In each, asset value is a function of cash flow and risk. So ultimately, same principle ही follow रहे कि valuation is a function of your sales, of your cash flow, and the risk that is involved in investing that startup. So now, so when we were discussing the DCF example, they were valuing an individual asset. But how will you value your entire company? For a collection of assets, that is a company, the process is no different. A company's value can be thought as the sum of all the individual DCF for each asset or group of assets it owns. Factories, stores, product lines, Many a times, a company's assets are similar enough where one DCF or other valuation analysis suffices to evaluate its cash flow streams. In other cases, we achieve a more accurate result by grouping companies' assets into different categories based on their growth and risk profiles and doing a separate valuation for each group. So it is simply saying कि अगर आपको एक कंपनी वैल्यू करनी है जो भी similar assets हैं based on their growth rates or based on their risk profile, you can calculate, you can carry out a DCF analysis for each of these group assets. So there are two type of assets when we are trying to estimate value and value of an asset. There are two type of asset. One is existing assets and one is growth or emerging assets. So existing assets are those which have been here for a considerably longer period of time, and that is why they have significant past operating information, which basically help us in forecasting the cash flows for explicit forecast period appropriately. These are generally assets that have established cash flow history. For example, a factory that has been in operation for 10 years. So for example, there is a startup which has been running for 10 years. So now we have its considerable cash flow history. So with much ease, we can calculate, at least for the explicit forecast period, we can forecast its cash flows for first 5 years. While no forecast is 100% accurate, existing asset cash flow estimates are generally higher quality. Why? These assets are generally more mature, resulting in predictable growth rate. तो more or less existing assets का क्या होता है? Growth rate stable हो जाती है and their cash flows become much more predictable, because obviously अगर आपके पास 10 साल का डेटा है तो उस 10 साल के डेटा से with a certain degree of precision you can still forecast your cash flows in comparison to early stage startup which does not have any information available. Then the second is the growth or emerging assets. These are assets with no or limited cash flow history. Growth rates are likely higher versus existing assets. With no operating track record, cash flow projections can be subject to considerable uncertainty and thus quality is often poor. These assets require higher discount rate than broader industry aggregates given their higher risk profile. Most startup assets fall into this category, which present considerable challenges to traditional valuation frameworks. So it is simply saying कि suppose एक early startup है, it won't have any significant operating history. अगर आपको 2 साल ही हुए हैं market में, you won't have, maybe you have not even started earning revenues. So in that case, you do not have significant operating history. Plus, there is a lot of uncertainty whether you will survive or whether you will have to shut down your doors. So even its cash flows are unpredictable, and hence we require a higher discount rate for growth or emerging assets in relation to the existing assets. So अगर हम companies को assets माने, तो जो आपकी publicly traded companies होंगी, जैसे कि Reliance and Tata, they will be your existing assets, and startups will be your growth or emerging assets, and hence जो भी investors होते हैं startup के, they require a higher rate of return. Then we come to what are the challenges to VC valuation. As discussed, startups have, so first they are discussing the challenges of intrinsic valuation. As we said that there are two major methods of estimating the valuation of a startup. One is intrinsic valuation, which uses the fundamental characteristics of an asset, or जो relative valuation है, it compares it with a similar asset. As discussed, so first they are discussing the challenges of intrinsic valuation. As discussed, startups have limited histories and are prone to failure, all of which makes valuing startups quite challenging. Existing asset valuation. So first, from the perspective of existing asset valuation, standard approach to valuing assets is to review assets' historical financial statements and extrapolate future cash flows from these assets. However, startups often lack sufficient historical data to assess future revenues, particularly in changing macroeconomic or competitive conditions. Among startups, existing assets are also a small percentage of overall value, which is largely tied up in future growth rate. So when I was discussing the book value method approach, I said that if it is a early stage startup, तो उसके पास इतने assets तो होंगे नहीं. So in that case, I will be arriving at imprecise estimate of the valuation of startup because most of its growth, most of its valuation is tied up in its future growth. And also it won't have a substantial operating history that I can predict the future cash flows with a certain degree of precision. Then comes the emerging asset valuation. The majority of startups' value comes from its investment in emerging assets, which leads to several challenges. Limited financial history hinders VCs in estimating revenue growth rate for emerging assets as well. तो existing assets तो होते नहीं हैं उनके पास, and most of its valuation is coming from its future growth opportunities. अब उन future growth opportunities को भी तो forecast करना बहुत difficult है because there is no substantial past track record for a startup. Even if revenues can be estimated, startups often report losses well into the future, which makes estimating future operating income and profit margins difficult. So even if we estimate the revenue, we very well know that startups do report losses. So for example, Zomato is still reporting losses, even though it is listed now. There is Tesla, which is reporting losses. So उस case में, like if you remember the DCF method, उस case में that when we try to arrive, if we are using their net income, we need to add back interest expenses and we need to add back non-cash depreciation and deduct all the capital expenditure from their net income figure. तो अगर net income figure ही मतलब negative में जाएगी तो ultimately most of your free cash flows will be negative. तो उस case में valuation exercise will be redundant. You cannot use that value. Finally, because the current return on capital is usually negative for startups, assessing the quality of a startup's growth, that is how much a startup's return on capital exceeds a startup's cost of capital, is without any basis. So this is what they are saying कि मतलब ultimately it is negative. So it will not make sense to carry DCF valuation in that case. Harshita,
Yes, D.
everyone has
It's
left.
yes, D. It's just us two.
So what should I do now?
Uh, I think just continue the lesson because it's like this that they will have the recordings with them, or we can just stop the session right now and ma'am can take up from the next class.
Or should I try to contact ma'am?
Yeah, we can do that. Let's just take a 2 minutes break. Just talk to ma'am and we can either continue or we can just leave it here right now.
ठीक है, तो मैं बात करती हूँ. इतना भी बुरा नहीं पढ़ा रही थी मैं.
नहीं, I was enjoying. अच्छा पढ़ा रहे थे. Don't think like that. I was enjoying.
चलो हर्षद, तो तुम्हें ही पढ़ा दूंगी. चलो, आई ट्राई टू कॉन्टैक्ट मैम एंड देन लेट यू नो कि मतलब क्या है.
हाँ, आप मैम से पूछ लो because there are still 45 like 40 minutes left for the class.
हाँ, काफी टाइम रहता है. ठीक है, तो मैं
हाँ,
अभी अपने आप को म्यूट में डाल रही हूँ फॉर कॉलिंग मैम.
sure, no issue.
ठीक है.
Okay.
So Harshita, I talked to ma'am and she said
Yes.
you can continue so that it
Okay.
gets recorded at least the lecture.
ठीक है दी. Then let's continue the class and 5 o'clock पे I'll tell you.
Okay, so I'll continue with the class. So next is identifying discount rates, utilizing standard approaches for identifying a company's cost of capital, that is discount rates such as CAPM requires market data and pricing information. So whatever the traditional approaches that are available for estimating the discount rate, they require market data. So this information will obviously be not available in case of startup because they are not publicly traded. With market data and pricing available, a DCF can estimate the cost of equity capital by comparing a target market price against the general market or a stock index. On debt cost side, a DCF can refer to publicly traded debt. Startups, however, will not have publicly traded equity or debt, and similar companies will also likely to be private. So extrapolating discount rates from them for your target company is also impossible. So that is what they are trying to say. Key market data will not be available for your startup because it is not publicly traded. And if you try to compare it with your peers, so most likely they are also private. So suppose you are working in a very unique venture, suppose in case of renewable energy. So usme most of the firms, most of the startups who will be working in that sector, they are likely to be private also, and hence you cannot also use their data for estimating the discount rates. Next is the terminal value. The terminal value accounts for most of the overall value in a DCF and is only an appropriate calculation for companies that will reach stable growth. Achieving stable growth for a startup is already a huge question mark given the high failure rates, as is estimating when a startup will reach stable growth. Today, even many public tech companies are high growth and continue to generate losses, such as Snap and Tesla. So when we were discussing the terminal value, we said that we will use a stable growth rate. Now, for a startup, it is a question mark that whether it will even survive. So when will they reach that stable growth rate is also uncertain. And there are many publicly traded companies like Tesla that are high growth firms and they continue to generate losses. So estimating ki matlab, when they will reach a stable growth rate period, that is also very difficult. Now we come on to the challenges of relative valuation. Challenges faced by VCs in performing intrinsic valuations carry over to relative valuation methodologies. Common relative valuation metrics. Relative valuations have to be scaled to a common metric. The most conventional metrics are ratios such as price to earnings ratio, enterprise value to EBITDA ratio, and enterprise value to sales ratio. However, because startups often have negative operating income, earnings and EBITDA multiples cannot be computed. So most of these startups earn losses and hence they report negative income. So us case mein we cannot use price to earnings ratio and enterprise value to EBITDA ratio because it is most likely to be negative. So then we will turn to sales figure. But then if we use price to sales ratio, suppose, then it won't be able to capture the cost structure of the startup. So this is what they are saying. Moreover, even if a startup is sales positive, sales multiples are more opaque than EBITDA multiples as they do not give investors a view into the cost structures of comparable companies. Finding similar startups. Typically, the company comparables and transaction comparable methodologies, as discussed later on, value a company relative to other publicly listed companies in the same sector. With private startups, finding the right universe of comparable companies and transactions is difficult due to lack of publicly available information on financials and valuation. Using public company vis-a-vis startup for valuation purposes is also problematic as public companies will be typically much larger and have lower growth prospects as well as lower risk profiles. So there are two valuation methods known as company comparable method and transaction comparable methodologies. which we will discuss later on. तो उसमें क्या होता है? So for company comparables, we normally use a publicly traded company's information and ratios. But startups do not have financial information available in the public domain. So in order to match कि मतलब ये दोनों comparable scale में हैं, that becomes difficult in order to match pair public company. And also public companies are not exactly comparable to startups because public companies tend to be mature, they have lower growth rates, and they have much more less risk in comparison to startups. So startups have uncertain futures, so obviously they have a higher risk, and obviously they have a lot of growth opportunities. So exactly, it's not a scale at which it's not a balanced scale on which you can compare public companies with private startups. Then we have high failure rates. As with DCF valuations, the high failure rates of startups make valuation using relative methodologies challenging. The relative valuation of a startup increases with a higher multiple, such as enterprise value to sales or enterprise value to EBITDA, which investors would also expect to increase the likelihood of survival. However, startups both grow and fail at such high rates that assigning a multiple to a startup to discern relative value may not have much basis. So suppose using public company comparable methodology, you assign a higher multiple to that startup. So you will also expect that this startup will survive, but then future is uncertain. It may or may not survive. So this is what they are saying, that startups both grow at much higher rates, and relative valuation does not take into account those high failure rates. Lastly, equity claims and illiquidity. As with the DCF, differences in investment terms can also greatly impact the value of a startup's issued equity. Investment round comes with different liquidation preferences, dividends, priority schemes, and other protective measure that makes it more difficult to assign just one equity value among different series of stock. So as we know that startups are basically traded in private financial markets where only a limited set of people like private equity investors, your VC firms, only those firms invest in them. So obviously, if they are negotiating on one basis, the terms and conditions are likely to differ from one private equity investor to another. And obviously, they will come up with their own special terms and conditions that, we want a board seat on your startup venture. We want dividends. While the other private equity investor may not want dividends. So all these terms and conditions will also impact the valuation of our firm, but this is not considered by the relative valuation as well as intrinsic valuation method. Finally, the relative illiquidity of startup equity also has to be taken account, and pricing an illiquidity discount is a challenge of its own. So startups are not traded in a public financial market, and hence their shares are relatively more illiquid. They are mostly bought and sold between private equity firms and VC firms. So it is a challenge for a PE firm or a VC firm to exit. तो उस illiquidity का भी discount hoga to valuation. So you need these are not considered by the DCF method as well as the relative valuation methods. So now we come to, in an ideal world, valuing a startup would be like valuing an established public company. Public companies typically have longer operating histories and are also required to make quarterly and annual financial disclosures to the public. Unsurprisingly, significant historical financial data greatly helps inform our ability to make more accurate financial forecasts for a DCF analysis, since we have a much better understanding of historical revenues and cost drivers. So as we discussed previously, public companies have a significant past track record, and you can simply use that information to forecast your future revenues. So even though the forecast will not be 100% accurate, but there is a certain quality to forecast because you have a much longer operating history or a substantial data based on which you are making a forecast. Moreover, public company filings include management's prospective assessment of the business, which can also be helpful in forecasting. So if you refer to the annual report of any publicly traded company, there is a section called management discussion and analysis, where they talk about the future of the company, what are its present circumstances, and they also provide an estimate of cost of capital. So you don't need to estimate it on your own. As already discussed, in addition to a lack of publicly available information, startups vary greatly in terms of operating and financing history, which creates additional valuation complications. Generally, the closer a startup is to an IPO, with presumably several years of positive revenue and a business track record, the more easily it can be valued in a DCF analysis like a public company. So, मतलब अगर आप you want to retrieve the information, operating financial information of, say, suppose Byju's, you won't be able to get it because it is not publicly available. And they are saying that DCF approach is much more valuable once the startup is here, once the startup has been in business for long, once it enters into the IPO phase. Okay, then the DCF method of valuation will be suitable because now it has a substantial track record of its cash flows. Earlier stage companies, which are more likely to have negative free cash flow or even be pre-revenue, cannot be valued with a DCF analysis, and thus valuations rely on more qualitative factors. So suppose you are a seed stage startup, you have just started out, you're developing your minimum viable product. Of course, you won't have any revenues. So how will an angel investor decide कि मैं आपको money दूं? So it will be based on certain set of qualitative factors. You won't be using quantitative factors like cash flows. Now, this PPT, the startup financing cycle. While every startup takes a unique path, the below presents an illustrated startup financing cycle as a company goes from pre-revenue to a mature public company. तो simply ये दिखा रहा है कि from early stage to its maturity stage where it liquidates by way of IPO. So what are the various financing options that are available to it? So if you are at seed stage, if you are an early stage startup, so you will raise money from angel investors or your friends and family. Once you enter into early stage or mid or late stage, you will rely on venture capital investors, you will rely on private equity investors, or you will anticipate that maybe I just want to sell my startup. So maybe you get acquired in a merger and acquisition transaction. And lastly, once it has been in business for long, it has been earning positive revenues, it has reached its break even, uh, and it is at a much mature stage relative to an early stage startup, it can go for an IPO. Based on startups operating and financing stage, we will utilize a mix of valuation methodologies to most accurately hone in on a startup's value. So there are different valuation methods that are suitable at different life cycle stages of a firm. So if it is at its seed stage or if it is at its earlier stage where you are relying on angel investor, or even if you are going for your series A funding round, so at that case you will be mostly often pre-revenue and you may be also lacking the minimum viable product, and so you will obviously have very limited operating history, and obviously the failure rate of startup at this stage will be very high. We may not know that it may or may not survive the market. So us case mein, the valuation methods that are available to you are mostly qualitative in nature. They use qualitative factors, and these methods are Berkus method, scorecard valuation, risk factor summation, venture capital method, book or liquidation value. Then we come on to mid or late stages where you go for your Series B or Series C financing. You have launched your product, you are growing revenue and you are growing at a rapid rate, but still your free cash flow may be negative. क्योंकि आपके एक्सपेंसेस बहुत ज़्यादा होते हैं उस स्टेज में, एंड यू नीड कैपिटल टू स्केल टीम एंड ऑपरेशंस. So in that case, the available methodologies are public or private company comparables and public or private transaction comparables. And उस केस में the latest financing round can be a good reference for starting your valuation. Then approaching liquidity event. So उस केस में, so suppose your private equity investor or venture capital investor, how will they liquidate your investment from your startup? So it is either they sell their shares in when the startup goes public or when your startup is acquired. So in this case, the available or suitable methodologies are discounted cash flow, first Chicago method, public company comparables, and public transaction comparables. Putting it together, valuation timeline. At Equities End, we have plotted the various valuation methods along a company's typical financing cycle to create a valuation timeline framework to guide our valuations. So basically वो यही बता रहे हैं that once it is at seed stage, what is the appropriate valuation method till it reaches the liquidation stage, then what should be the appropriate valuation methods. So when it is in its early stage, तो उस case में we mostly use qualitative factors. So you try to answer the questions like, is the business idea sound? Is the business idea sound? Is the technology that they are using, is it even feasible? Is there a prototype? Is there a working product? How is the management? Like, suppose you have a CTO who worked in Facebook. So that may attract additional points that yes, they have a well qualified experience management, whether their education came from a good business school. So in that case, even that will attract higher valuation. Whether they have entered the market and what is the potential market size, who are your competitors, you try to answer such questions. Then you come for mid-stage to late-stage companies where you use a combination of qualitative as well as quantitative factors. So they are saying the minimum price hoga, so your previously funding ground, that will serve as the benchmark for you to raise future funds. So latest round में valuation क्या था? What are the type of investors right now you have? So suppose you have SoftBank as your investors, so obviously that will attract a valuation premium. You know, they have good set of investors in their kitty, so it may be a good venture. What is the positive or negative news? What has been the growth rate since the last round? And what is the overall condition in the sector, in the industry in which you are operating? So the floor price will be provided by your last funding round. Okay. Then we can compare it with similar publicly traded companies or your competitors. So you will see that how much competitors have raised and at what valuation they have raised. So recency of competitors' funding rounds. Quality of comparables. Now you have, suppose you are relying on a similar publicly trading company's PE ratio. But as we said that, you know, it may not be much reliable because a publicly traded company has low growth opportunities and it has less risk. So you need to make certain adjustments to that PE ratio when you arrive at your valuation using that. Any pure play competitors, that is if you have any one-on-one direct competition. So for example, in food delivery startups, we have Swiggy and Zomato as pure play competitors. General sector dynamic, again, that what is the overall condition in your industry. What do public comparables indicate? So वही मतलब that what is the PE ratio of a similar publicly traded company. और जो max price जो provide होगा, they are saying ceiling is provided by M&A comparables. So there will be similar startups that might have been acquired in merger and acquisition transactions. So normally क्या होता है M&A transactions में whoever is the acquirer, they try to provide a premium to the valuation. So that will provide you the maximum valuation that your startup can achieve. So the first is recency of M&A transaction. Whether any premium was paid in that M&A transaction. Then the overall market condition, quality of comparables, any pure play competitors, and general sector dynamic. And once it reaches the liquidation stage, that is, it prepares for IPO or it may be getting ready to be acquired by some another firm. So the available valuation methods to you are discounted cash flow, first Chicago, public company comparables, and transaction comparables. So in that, you will estimate your discount rate. What are the company fundamentals? So what is the book value of the asset? What is the cash flow generation ability of these assets? Then macro factor also you will look into account, general capital market dynamic. So if you observe that right now a lot of startups are going for their IPOs, this is because the market sentiment is very high, the investor sentiment is very high. So they are trying to capture the market and they are getting listed at very high prices. Then what is the quality of comparables, any pure play competitors, and general sector dynamic. हर्षिता किसी ने ज्वाइन तो नहीं किया था ना?
No,
Okay.
nobody.
ठीक है. So now we come on to the seed and early stage. So what are the valuation methods that are available for early stage startups? First, we discuss the Berkus method. We think of the Berkus method as the foundation of seed and early stage valuation methodologies. Named after renowned venture capitalist and angel investor Dave Berkus, the methodology relies on his premise that fewer than 1 in 1,000 startups meet or exceed their projected revenues. So Dave Berkus basically came up with this methodology of valuing startups based on a certain set of qualitative factors, because he said how much forecast you do, they turn out to be pretty much useless. And of course, if you're valuing an early stage startup whose uncertainty is very much in question, you can't forecast its revenue with 10% accuracy. So the much better approach is to use a certain set of qualitative factors in order to value that startup. Given financial projections tend to be inaccurate at an early stage company, this method instead focuses on risk and assigns a financial valuation to each of the 5 major elements of risk faced by young companies. So, what are those factors? One is soundness of idea. Whether it is a working idea or not, whether it is a feasible idea or not, whether they have a prototype or not. Third is quality management team, whether they have experienced co-founders in their team, whether they have well qualified CTOs in their team. Then strategic relationships. Strategic relationships, for example, whether they have, so suppose you are an e-commerce company and you have come up and you are simply selling artifacts, and suppose you have confirmed 2 or more suppliers who will sell on your platform. So that is what it means by strategic relationships, that you have formed some relationship, you have some customers, you have some suppliers. And product rollout or sales, कि अभी sales है या फिर नहीं है, whether the product has been rolled out or not. To the company you are valuing, add a 500K in value for each of the following risk reduction elements to the extent they are present. So suppose if there is a sound idea, then the maximum value that you can assign to that factor is $500,000. You can assign a much lower value, but 500K ke beyond nahi ja sakte. So the maximum valuation under Berkus method will be 2.5, because there are 5 factors, and if the maximum you can assign a value of 500K, तो $2.5 million वैल्यूएशन आएगी. So suppose if that startup has a sound idea, so you will assign a value of 500K. They have developed their app for the prototype. They have developed their app, but you think it can be improved. It has certain bugs, so you can improve it. So you will just give it a valuation based on prototype 250K. Then you see that the management has quality co-founders. They have studied from good B business schools. The CTO is from Facebook. So you give the entire valuation of 500K to quality management factor. Strategic relationships. So it has confirmed 2 or more sellers that will sell products on its app. So you assign 100K, but it has not yet, it's pre-revenue stage. It has not even released its product. So on the basis of product rollout or sales, you are only giving $0 क्योंकि अभी तक तो कुछ revenue हुआ नहीं है. Then you simply add them up and the total valuation will come out to be as 1.35 million. So key advantages, as you can see, that it is straightforward and simple to use methodology. Good for pre-revenue or very early stage business who lack financial metrics. So जिन्होंने अभी तक revenue भी नहीं start किया, उनको value करने के लिए it is a very good metric. Provides a flexible framework which Dave Berkus says should be altered to emphasize those risks most important to an investor. So suppose for me, the most important factor may be quality management. So I will put more emphasis on it. But for you as a VC investor, the sound idea may be more important. So accordingly, matlab, it is specific to a particular person. Key disadvantages. It is very simple and it does not consider a lot of factors that go into startup valuation. Koi revenue projections nahi use ho rahi. Even the risk of survival, they are not considering all of this. And second is it ignores geography and market or sector dynamics. So suppose overall मेरी इंडस्ट्री की कंडीशन बहुत खराब चल रही है. So it's not considering that. It is not considering that factor. जबकि this will affect my performance. So it is not considering geography or market or sector dynamics. So we now come on to scorecard valuation. Similar to the Berkus method, scorecard valuation analyzes a number of factors to determine the valuation of early stage startup. This method requires determining the average valuation of pre-revenue companies in a particular geographic region. From there, you can value your target relative to the average based on the following factors and weighting percentages. So scorecard valuation, what is it basically doing? It uses a more comprehensive set of factors relative to the Berkus method. But in this case, it is also prescribing the weights that you should use with a specific factor. In Berkus method, you were not assigning any weights. You were simply taking all the factors equally with equal weights. So it considers management strength, quality of management, whether the co-founders are from good business school, whether they have significant experience in that sector or not. So it gets a weightage of 30%. What is the potential market size? Kitna capture kar sakta hai market startup? That is given a weightage of 25%. To your product or technology, a weightage of 15% is given under scorecard valuation. Then what is the severity of competition? So if the degree of competition is high, then the survival of the startup can be difficult. So it is given a weightage of 10%. Marketing or sales or partnerships, so all these strategic partnerships, whether any revenue has taken place, it is given a weightage of 10%. Any additional investment needs, whether any financing needs will be required in the future, 5%, or other factors go 5%. So how does it work? Determine the average valuation of pre-revenue companies in the same region as the target company. So पहला step क्या होगा कि like suppose I take Delhi and I find out that there are about 120 pre-revenue companies in the Delhi region. Then I will take the average valuation of those 120 प्री रेवेन्यू कंपनीज. प्री रेवेन्यू कंपनीज मतलब अभी तक उन्होंने सेल्स नहीं स्टार्ट करी है. सो मैं उनका एवरेज वैल्यूएशन लूंगी उन 120 कंपनीज का who are operating in Delhi, operating in Delhi, where the target company also operates. Compare the target company to similar companies in your region using the factors and weighting above. Under the comparison percentage column to the left, assume 100% is the average for similar companies and then assign a premium or discount to the target. So ये जो सारे factors हैं, so for 100% is the average valuation for similar peer companies that are operating in the area. Then I will compare my target company to a similar peer company, to a similar peer revenue company that is operating in your area and see कि उस parametric में जैसे management team strength में whether it is performing well or whether it is performing poorly in comparison to other similar companies that are operating in your region. So let's suppose if we take management team and strength, it has been assigned a weight of 100%. And I see that relative to other peer companies, it has a much more stronger management team. So I will give it a comparison percentage of 125%. 100% average value है. So मैं उसको premium दे रही हूँ और ज़्यादा. Market size opportunity. I see that this startup can capture a substantial market. So I am giving it a comparison percentage of 150%. If I see that its product or technology is more or less comparable to a similar peer company that is operating in the same region, तो मैं average comparison percentage ही use करूँगी 100%. So that is how I will assign comparison percentage for all of these comparison factors. Then what I will do simply, I will multiply weight percentage into comparison percentage and calculate factor. So multiply each factor's weight percentage by the relevant comparison percentage to get your factors. फिर उसके बाद simply क्या करना है, you will take the summation of each of these factors, which works out to be 1.155. और सबसे पहले स्टेप में you had computed the average valuation of pre-revenue companies that were operating in your region. So suppose it was 2.5. तो simply आपकी target company की valuation क्या होगी? 2.5 into 1.115. That works out to be $2.9 million. What are the key advantages? It is good for pre-revenue or very early stage businesses. Then it is much more comprehensive. As we can see, it is using more factors relative to the Berker's method. And obviously it is good for pre-revenue companies क्योंकि हम यहाँ पर कोई cash flow projections नहीं कर रहे या फिर revenue projections नहीं कर रहे. Based on certain qualitative factors only, you are assigning a valuation. Key disadvantages. Finding data on the average pre-revenue company valuation in a geographical locale may be difficult. So as we said that the information about startups is not publicly available. So how are you even expecting me that I will be able to find those pre-revenue companies in a particular area? So that is a challenge. Average valuations are often distorted by outliers. So suppose in your similar peer company set, you have a unicorn. So obviously in that case, the valuation will be biased upwards. So it may not be representative of the peer company set. Method is inherently qualitative due to lack of operating history and speculative nature of early stage companies. So we are not using any quantitative fundamentals such as revenues or cash flows. So more or less क्योंकि ये मतलब qualitative है, so it tends to be subjective. Method is quite simplistic and does not consider all risk factors. Obviously there will be many more factors that you consider while valuing a startup. So it does not consider all the risk factors. Then we come to risk factor summation.
Only 5 minutes left.
हाँ तो मैं ये सोच रही हूँ like let me finish with risk factor summation. I'll be able to explain it like.
Okay.
ठीक है? Thank you. The risk factor summation method analyzes a broad set of risk factors relevant to the pre-revenue and other early stage startups. This method reflects the premise that higher the number of risk factors present, then higher the overall risk in achieving a strong exit. So it is another method that considers a much more comprehensive set of factors, and it says that if there are a number of risk present right now, then obviously I will have much more difficulty in exiting at an attractive price in future. Management risk is most important at the early stages, but this method also seeks to quantify risk related to politics. So it considers political risk. Political risk is simply, the risk that arises out of sudden changes in the government, or sudden changes in business rules and regulations. So for example, China has now banned its edutech startups from raising funds or from publicly listing themselves. So now many of the VC investors of private of these Chinese edutech startups are finding it difficult to exit from those ventures. So obviously, if you consider the political risk in Chinese edutech startup, it is very high and it does not make sense to invest into them. Then there is manufacturing risk, then sales or marketing risk, funding risk, again severity of the competition, tech, litigation risk, whether it has the potential of attracting any lawsuits in the future. International risk will arise if it has global operations. So suppose abhi jaise Brexit ho gaya. So a lot of Euro-based startups would have been affected by it. Then reputation, that so if we see that Byju's has a good reputation, so it will attract a much higher score. And then what business stage uh, the startup is in. How it works, similar to the scorecard method, risk factor summation requires you start with average valuation of pre-revenue companies in your geographic region. So pre-revenue valuation in your area was $2.5 million. From there, each risk factor in the description above is scored as follows. +2 is very positive for growing the startup and exiting it successfully. So if you see that it has a quality management, and so you will assign a score of +2. +1 is positive, 0 is neutral, -1 is negative for growing the startup and exiting successfully, and -2 is very negative. Then adjust the average valuation positively or negatively by 250K for every 1 point added or deducted from the target startup. So what what are you doing here is, सपोज आपने मैनेजमेंट कंसिडर किया और आपने कहा कि बहुत ही क्वालिफाइड लोग हैं, सो यू असाइन अ स्कोर ऑफ +2. Now for every one score you will multiply it by 250K. So here you will multiply it by 250 into 2, 500K, and this 500K will be added to the average pre-revenue valuation of $2.5 million. Stage of business, it is still in its early stage of business. It still has to reach its pre-revenue, it still has to reach its rapid growth stage. तो इसलिए आपने उसको 1 score assign किया. So you will multiply it with 250 and you will add 2.5 million plus $500,000 plus $250,000. Political risk. So there has been a new government in power and you anticipate that it might change some business policies. So that is why you assign a score of -1. तो अब आप क्या करोगे, that you will deduct -1 into 250K because every point is attracting 250K का valuation. So you will attract 250K from $2.5 million. So that is how you will assign score, and accordingly adjust the average pre-revenue valuation. So the total company valuation as per this approach is $4,000 million. Key advantages. Consider a much broader set of factors than other seed and early stage valuation methods such as Berker's and scorecard, based in local data concerning average pre-revenue company valuation. So it is much more localized because obviously you are using, if your startup is operating in Delhi, so you are using Delhi based data. We can take it to nationality too, कि मतलब इंडिया में ऑपरेट करें तो आप लोकल स्पेसिफिक डेटा ही यूज कर रहे हो कि आप इंडियन प्री रेवेन्यू कंपनीज ही यूज कर रहे हो. And obviously, it uses a much broader set of factors. What are the key disadvantages? Again, what were the disadvantages associated with scorecard valuation? वही disadvantages है for risk factor summation method. Finding data on average pre-revenue company valuation in a geographic local may be difficult. Average valuations are often distorted by outliers positively or negatively, and the method is inherently qualitative. So it is more or less subjective. So I will stop here now. Okay, Harshita, you can stop the recording.
Okay.
Thank you, everyone.